Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
This is Gary Wilson. Welcome back to the Massive Passive Cash Flow podcast. I'm glad you're back and listening. Be sure to take notes unless you're driving. If you're driving, please don't take notes. Just you can rewatch, re-listen to it later. You can look at the show notes, all kinds of stuff you can do. But we have a great guest today, Brian Davis. He's got a very interesting life history, and he's got a great program that he's got going on right now for investing. And there's lots of questions I want to ask him about what he's doing. But before I do that, let's go and introduce him. So, Brian, first off, thank you for doing this. Welcome aboard. I know we're lucky to have you. You've got a great story to tell and lots of great examples,
Oh, Gary, thank you so much for having me. I'm excited to be here.
Yep, you got it. So to start with, most of us don't start off investing. We start off, doing something else, going in the military or going to college and getting a job. But kind of take us from that point where, what was the impetus of you pivoting from wherever you came from to what you're doing now in real estate, if you don't mind sharing,
Yeah, no, not at all. I graduated college back in 2003. I had zero idea what I wanted to do with my life. No idea whatsoever. So my parents were kind enough to set me up with some informational interviews with some of their friends. And one of them owned a subprime mortgage lending company, which, in 2003, that was all the rage, right? I mean, that was before they got vilified. And anyway, the guy offered me an internship. I didn't have any other ideas or anything better to do. So I was like, sure, I will take a summer internship. And at the end of that summer, the guy that I had interviewed with, he was one of the two partners that owned it. He said, look, I don't need another loan officer. What I need is someone to help me and my partner with our hard money loans. Because as a side business, they lent hard money loans to real estate investors. Mostly flippers, and also people doing the BRRRR method, buying fixer-uppers and refinancing them to keep as rentals. So I said, okay, why not? I mean, I didn't know anything about anything, but it sounded fun. So I started working with these real estate investors and watching them just crush it, right? In 2003, 2004, 2005, everybody's making money in real estate. And so I'm sitting there thinking, I could do that too. What's to stop me from doing the same thing? So I went out and I just plowed all of my money into real estate investments, did not learn any of the fundamentals, made every mistake in the book. And in 2008, I lost my shirt. I mean, I got my rear end handed to me.
Yeah.
But learned some good lessons, had some expensive tuition, if you will. But yeah, went out and ended up leaving the lending field because no one was borrowing hard money loans anymore, in 2008. So I went and I worked for an e-commerce company that serviced landlords and real estate investors. And it was one of those things that I never would have gotten that job if I hadn't been a real estate investor and landlord myself, right? So that was sort of the silver lining, that one window closes, another door opens kind of thing. So I entered the online space, and in 2016, I ended up launching my own business with a former colleague of mine, and that was how SparkRental was born. And that's a whole nother story. We've done all kinds of different projects with SparkRental, and it's been a lot of fun. But it's a longer story.
Yeah. Okay. So now, so this the recession years obviously were pivotal for you, like they were for a lot of people. We were lucky because we had a lot of properties, but we also had a lot of equity. We were able to weather the storm. We weren't able to raise our rents, of course, because that was not the time to raise rents.
No.
And we had people that were losing jobs. Our tenants were losing not a lot of, but it was enough to bloody our nose a little bit. But fortunately, we had been at it longer, so we had a more of a stable footing. But I still use it as a pivotal time frame too. I've launched a brokerage company, a property management company, title company, appraisal company, because it wasn't like the business stopped; it just changed. Now all these properties were changing hands. It's not like a bulldozer comes up and tears all these properties down. It's not what happens. They get sold. So the transaction volume was extraordinarily high. There was a lot of turnover of properties. And we just happened to have the right model at the right time. That's really, people always ask me, boy, did you go to Harvard? How did you come up with this plan? I'm like, I didn't have a plan. We just happened to be at the right time at the right place with the right model. That's really what it was. I know I might just bust a lot of bubbles there, but we were investors and we worked with investors. and we still do today. And so take us forward, take us to the next step, like getting into investing yourself, doing syndications, things like that. How did all that start to develop and come together?
Yeah. So, as I mentioned, our business, SparkRental, went through a lot of iterations. One of the
Yep.
things that you learn when you are an entrepreneur is that what you think your business is not necessarily what the market thinks your business is, or should be, rather. Sometimes the market tells you what your business should be. So, our original vision, we wanted to create a one-stop shop landlord property management software service, for mom and
Okay.
pop landlords, not for larger property management companies, because there were already some
Hmm.
good software platforms for the larger PM companies. But that turned out not to be the ideal business for us. Neither my co-founder nor I are technical people. We're not coders, but we do know a lot about real estate investing, or at least we did by that time. I didn't back in 2005, but by 2016 I certainly did. So we started focusing more on education and teaching real estate investing, teaching how to create passive income through real estate. And one of the questions that came up again and again and again from both our course students and just from our audience members in general was, hey, can I just invest money with you guys on one of your deals? Now, I was living overseas at the time. I've been an expat for almost 9 years now. So I was no longer actively buying properties in the States, which was a bit of I felt a little out of alignment in that. I'm teaching real estate investing, but I was no longer actively buying properties myself. And
Yeah.
so my partner and I, we kept saying, no, no, we're not, we can't partner with you guys on any real estate deals. And then finally we looked at each other, it was like the 500th person that asked us this. We were like, well, maybe there's something here. Maybe
Yeah.
what would it take for us to say yes to these people? So we found a boots on the ground investor. He was based in Michigan, and we did a couple of single family deals with him, opening it up to our audience to participate in fractional
Mhm.
ownership in that deal alongside of us. And the returns were fine, but there was just no money in it for my partner or me, right? Like it didn't
Okay.
it didn't really earn us anything, and it was a lot of work. So we were like, oh, well, no wonder no one else is doing this. Um, but it was around that time that I had started investing in passive real estate syndications. And for anyone who's not
Mhm.
familiar with that term, these are just group investments in larger properties. So you invest a relatively
Okay.
small amount of money in a big property like an apartment complex, and you get all the
Mhm.
benefits of ownership in that. You get the appreciation and the cash flow and the tax benefits, but you don't have to become a landlord. You don't have to manage it or worry about any of that stuff.
Yeah.
So I had started investing just personally in some of those. So I went to my partner and I said, hey, buying properties actively, buying single family homes to either flip or, keep as rentals, that's too much work for, a co-investing idea where we bring our audience in to participate. But a passive real estate investment, that's not really any work after the initial vetting. What if we tried that? So
Yeah.
she said, well, okay. And we did a pilot deal and it was a success. We opened it up to our audience. We let people invest with as little as $5,000 per person in that deal. And that might not sound like chump change, and it's not chump change, but compared to the typical minimum investment in a syndication, it's a lot
Yeah.
lower. Typically, you're looking at a 50,000, 100,000, sometimes even $250,000
Yeah.
minimum investment in a passive real estate syndication. And that really locks out a lot of everyday working people from
Right.
participating. You have to put 100,000 into a single asset, a single property. But if you can put $5,000 in it, that's a lot more accessible for the average person. So
Right.
that's how our co-investing club was born. We get together every month and we vet different passive real estate investment deals. Anyone who wants to participate in a given deal can do so with $5,000 or more if they want. And one of the
Okay.
key things for us, as we mentioned, we really wanted to be able to service everyday people. So all of the deals that we review in our club allow non-accredited investors, because that's the other really big challenge with real estate syndications is not only is the minimum investment typically very high if you go in by yourself, but many of them, maybe even most of them, only allow wealthy accredited investors to participate. So it locks out, those normal middle class people. So
Yeah.
that is a core value of our investment club, is just inclusivity and making sure that all of the investments that we vet as a club are open to non-accredited investors in addition to the wealthier accredited investors.
And what's the name of the club?
So our company is called SparkRental, and it's our
Yeah.
co-investing club. So SparkRental co-investing club.
Okay. Now, when you're vetting the deals in the club, is a club meeting in person? Is a meeting online, like on Zoom or something? Or
Yeah, we meet online. We have members from all over the country and in some cases all over the world. So yeah, we meet
okay,
online. We aim to meet twice a month. One for a deal presentation where we vet a deal together as a club, and the other
okay.
for an educational presentation. We'll bring in some kind of subject matter expert or someone else to, deliver a class basically to help make us all better investors.
Well, this is pretty interesting. So everybody listening, you know, turn off all distractions for a moment. So your participants can come on to the Zoom call. There's twice a month, once a month. You're vetting deals. So you're actually vetting the deals with the people who would be participating in the investing for profit. They're kicking in 5,000, 10,000. See, that is phenomenal because a lot of the folks that I've worked with in the past and have interviewed, they'll vet the deals internally, right, and then present them to all their investors. Well, here you're allowing your investors to participate in the vetting, which I think is, what a critical distinction. I mean, they're part of the success, and they learn. So it's like they're learning and they're earning, right? Um, I'd like to be part of that myself because I haven't heard of this before. This is definitely unique, Brian. I mean, kudos to you for doing this, and I hope I just got everybody's attention with that.
Well, Gary, I'll add you to the club email list. So but yeah, one crucial distinction that I want to make is my partner Denny and I, we are not sponsors. We're not syndicators. So
yep.
we don't get a cut of any of the money that's invested. If we did, we would be selling securities, and that would be a whole different ballgame, right? So what you're talking about is, a lot of the people that you bring on the show, those are sponsors. They're syndicators.
Gotcha.
Who are presenting deals to their investors and raising capital.
Mm-hmm.
We are not raising capital. We simply charge a flat membership fee for our investment club. So our service is the investment club itself. So
gotcha.
I participate personally in almost every one of these deals. I mean, to date, I have participated personally in every single one, but I can't promise that I'll always have the capital to do it. But no. So I mean, we're all in the trenches together as an investment club, vetting these deals together, and having 20, 30, 40 sets of eyes on these deals on a group call. It makes a big difference. You're crowdsourcing the vetting of these deals. So, and I'll give you a couple of quick examples. So we had a sponsor come on. They had a deal in Dallas, Texas. I've never been to Dallas. I don't know anything about the Dallas market. And we had a member in our club who raised her hand and said, "Hey, I live 5 minutes down the road from this apartment building. I know the building. I drive past it every day on my commute to work." And she told us all about the neighborhood and about the market. She's like, "Yeah, there isn't enough professional housing in this market." And that, the apartment complex, that's what they offer was, housing for local professionals. So she said, she basically said, "This is a great deal and we should do it." But we never would have known that. Like I don't know anything about that little sub-market, right? We have another quick example. We have an insurance expert, someone who works in the insurance industry, who, she hops on all these calls and she's very quick to say, "I don't like the way that this sponsor is forecasting their insurance costs. I think they're underestimating how much the insurance premiums are going to be rising over the next few years." It doesn't necessarily mean that we won't do that deal, but we take that into consideration, right? We say, all right, so maybe they may not hit that 20% IRR or whatever that they're targeting every year. It might look more like 15%. If they didn't estimate their expenses as conservatively as we would like. So it's great having an entire club's worth of real estate investors having their eyes on each one of these deals.
Well, plus you have obviously sounds like you have team members. I call them team members in multiple markets around the country. So you actually have your thumb on the pulse of multiple markets, and so you have an array of opportunities available to you to vet, so you can really pick the best of the best. And plus, the markets. I mean, you can, the the demographics, the social graphics, the economics. I mean, all this data is now so much more easily readily available than it was even when you started 20 years ago. I mean, this is worlds apart from them. And it allows investors, and by the way, statistically, right now, 56% of investments, real estate investments, are out of state. That means, I'm here in Virginia. That means more than half my investments are other states. Well, 20 years ago, it was not even, I mean, we were investing out of state, but not like that. So you've got an excellent model. If you don't mind me asking, in terms of ownership structure, are you, uh, as much as you're able to share, are you forming an LLC? Then each person is a member of the LLC. Is it fractional ownership, or if you don't mind sharing, because people are always asking those detailed kind of questions. Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live, be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestateWithGaryWilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care.
I don't mind sharing at all. We have a very open and transparent business model. So yes,
Okay.
for each deal, we create a unique LLC. Everyone who participates in that deal gets listed as an owner of the LLC, proportionate to the amount that they invest. So,
Okay.
if there's 10 of us and we each put in $5,000, then, we each get 10% ownership in that LLC. So you can think of it as a fraction of ownership in a very large, high dollar property.
Okay. Yeah, because I know the subject of fractional ownership has come up a lot in the last decade. It originally started with like vacation homes where people were used to timeshare, which is a share of time. You get a block of time of ownership, but there's also fractional ownership where you literally own a physical fraction of the property. It's like you own a portion of it. Is that more like what you're doing? Like, I guess I should elaborate a little bit more. So in an LLC, historically, you would own a share of the LLC. So you would own 10% of the LLC. And in translation, that means you own 10% of the property, because I'm assuming you're doing one LLC per property. Is that
Correct. Yeah. Now,
okay?
sometimes it might be a portfolio of properties, and that's what is being offered by the syndicator. But yes, generally speaking, you're absolutely right. The LLC becomes the limited partner, the LP that's investing in a property or a portfolio of properties. So yes, that's right.
Gotcha. Okay. So now, if someone wanted to sell their 10%, they have the right to do that, or does the LLC, the body of the LLC, excuse me, have the right to vet any other buyer of that person's 10% share? Or if, I mean, maybe it's not even allowed. Well, kind of, I guess, just tell me instead of me guessing. you know what happens when that
Yeah.
scenario pops up.
So, real estate syndications, these are medium to long-term investments, right?
Mhm.
With no liquidity from the sponsor. So, we don't want any of our members thinking that they're getting out of this in a year from now or whatever.
Right.
So they all know, they go into each deal knowing it's a long-term investment. And maybe it's not. Occasionally we will invest in a shorter-term investment. But that being said, emergencies happen. Someone might die, or whatever, and their estate would inherit their ownership interest in the LLC.
Gotcha.
So someone could theoretically sell their ownership interest maybe to a family member or a friend or whatever, and that's fine, but that's not the way that we present this, right? I mean, these are not liquid investments for the most part. These are long-term commitments, largely speaking.
Gotcha. Yeah, that makes sense. I appreciate you explaining that. So, and that's now I'm starting to think of all kinds of other questions. So, um, you have partners, uh, vendor partners in the areas where you buy, like in other words, in Dallas, you already know three great property managers, or is that how do you address that, or they're the members themselves, like the person in Dallas, he or she may say, "Yeah, I already know the number one property management company here." How about that part of it? You know?
So what we invest in, these are completely passive investments. We don't have to do any of the asset management. The general
Ah,
partner or the sponsor, they handle everything from buying the property, financing the property, managing the property, marketing the property. That's they do all of that. We are passive investors in this
gotcha.
larger venture, basically, and this larger property. So we don't have any
Mhm.
management obligations or labor obligations involved. We are simply writing a check. Proverbially speaking, it's you're wiring money in the
Yeah,
21st century. But yeah, we're just funding it. We don't have any of the labor, and that is exactly what I want nowadays in my investments. I've been there and done that as a landlord. I have unloaded all of my rental properties. I don't want any of that anymore. That's part of being overseas, being a dad, being a business owner.
right.
I don't want to spend my free time, unclogging tenants' toilets, right? Like,
Yeah,
I just want to write the check and go about my business and go back to traveling and having fun. So, yeah, these are completely passive investments. It's, there's no labor required on the part of any of the investors.
excellent. What's amazing is you've been through all that, and yet I don't see a single gray hair on your head, man. It's not there. A lot of us guys, I mean, I always tell people every gray hair has a tenant story behind it, you know.
Right.
So, but I got to the same point. The direct ownership. I mean, there's pros and cons to everything, but when you have management responsibilities, it just sort of it'll wear you out. I mean, it kind of takes away the luster of having the property to begin with. So we were doing different things over the years trying to solve that dilemma. So I like what you're doing. So really, you really do have sort of a fractional ownership framework, because in that framework, you're right. You're not you don't have direct responsibility for management and all that goes with that. Um, that's ingenious. Now as far as locations, there obviously there's you've got the top 50 MSAs and you've got the top 100 MSAs, and there's states that are where people are leaving the states and other states where money's leaving. It just it's what's changing right now in the country. I mean, it's like you might as well put a blindfold on and throw a dart at it. But there are some consistent trends, and people leaving certain states, moving to certain states, and money people always follow the money. So we actually track the movement of money from state to state and county to county, even counties between states. It's interesting how we can do that. But do you have a method for that? Like, how do you determine what geographically what areas you go to? Do you have certain states you like better than others, or how does that part work into it?
Yeah, so there's two real answers to that question. One is that we are location agnostic for the most part. One of our core values is diversification. We want to spread small amounts of money over a lot of different markets and a lot of different sponsors and a lot of different property types. That is really a core value of our club. Now, that doesn't mean that we want the sponsors who we're investing with to be generalists or diversified. Like, we want to diversify by investing with a bunch of like niche specialists, right? Who know
Yeah,
their one market inside and out, and they know their one property type inside and out. And they have, their super niche investing strategy that is tried and true. So, we want to invest with specialists, but we want to invest with a lot of different specialists. So we get the diversification without actually investing money with jack of all trades kind of investors, right?
yeah.
So that's one answer. Now, the slightly more nuanced answer is we do try to avoid markets that are too that are not investor friendly. To try to put it as delicately as some
Yeah.
some markets are very, very tenant friendly in their regulation. They are not investor friendly at all. Doesn't mean that we won't consider those markets, but we are wary of any markets that are just not investor friendly.
Yeah. Yeah, I understand. I always try to be careful when I talk about this subject, but it really is important. I mean, if you look at the macro industry of real estate, clearly policy, legislation, even lending programs are all leaning towards rentals, right? There's almost nothing out there right now for homeownership. It hasn't been for a while. Warren Buffett said in 2011, "Hey, I wish I could buy 100,000 single family homes. I'd do it." And he didn't do that. He actually bought Prudential real estate brokers, but he also said we're going to become a renter nation. And so if you look at policy like in California, clearly it's aimed towards investors and builders either building new or remodeling old properties to be used as low income housing, subsidized housing, affordable housing, if you will. And but in other states don't have that problem. However, as a whole, we are definitely short a lot of units in the country. We need anywhere between 4 and 7 million housing units. But in any case, what I'm getting at is you have to look at that stuff and you have to really take it seriously because it does impact your business. So in states where they have more tenant rights and fewer ownership rights, well, that means something to an owner because it's your asset, it's your money. You know back remember 150 years ago, it was all about the landowner. That person had the most rights. Well, now that's been chipping away at. However, there's other states that are definitely the laws are more pro owner, and it's and there's great loan programs out there too, but I won't go into that rabbit hole. I just want people to recognize all this stuff is accessible, guys, online. You can just Google, the most tenant friendly states, and you can Google the most owner friendly states and kind of figure things out from there. Um, now when you're looking for the properties, it sounds like you can also have a variety of sectors. In other words, multifamily, storage, office. Is that what you're doing? You're just really you're not locking yourself into one sector. You're wherever there's a deal, you're doing the deal. Is that pretty close or?
Correct. Yeah, we love to diversify among different property types. So we look first at syndicators
Mhm.
who we think are doing good work. And obviously we vet the deal very carefully as a club. But what my partner and I do, I mean, part of the value that we are providing in managing this club is doing all the networking with sponsors, right? With syndicators and
Mhm.
trying to find syndicators who are doing great work and mitigating risk well, who are establishing a good track record of historic returns and identifying those sponsors who are very promising. And
Mhm.
then when they have deals come along, we bring those deals in front of our club members. But yeah, so we've done mobile home parks, we've done storage, we've done multifamily, of course. I mean, that's sort of the bread and butter of
Mhm.
syndications. But we've done industrial, we've done retail. We've also done notes and debt investments,
Okay.
which have the advantage of consistent cash flow and often being shorter term. So yeah, I mean, coming back full circle, that is truly one of our core values as an investment club is diversification and spreading our money among
Yeah.
a lot of different types of properties, different syndicators, different cities and states and
Right.
markets. Yeah, so that is truly one of our core focuses.
Well, I like the fact too that your philosophy is actually really good because it's clearly you're diversified geographically and within the real estate industry, you're diversified by sector too. Um, and also your folks can, it's almost like dollar cost averaging. They can, whatever deal they get into, they can just put in whatever 5,000, the minimum, like you said, is way better than 250,000. And you do that enough times, the market goes up, the market goes down, but over time you're ahead of the curve. Um, so I really like that whole philosophy. And I know people are probably when they listen to this, they're going to think, "Gee, I wish Gary asked him this question and that question." And I'm trying to think. There's so many things I want to ask you, but one of them is timing, like where we are in the economy. So you and I both went through the Great Recession. We went through the the leading up to the Great Recession. It was just like money was just everywhere. I mean, you could just raise your hand and people would throw money at you. And
Right.
then the recession hit. That all changed. But the way it is right now, do you see any shift in your strategy coming down the road, or the way the market could turn? Um, any thoughts on that as far as timing? Is it maybe time to to buy more or time to buy less, or what are your thoughts there as far as timing goes,
Yes. It's a wonderful question. Again, I'm going to give you two answers. One is sort of the higher level answer, and then I will drill down and answer your question more specifically. So
Mhm.
the higher level answer is that I'm a huge fan of dollar cost averaging. And that's what I do with my stock investments. It's what I do with my real estate investments. Every month, I'm just investing in another one of these deals, right? So that is in itself another form of diversification, right? You're diversifying across time and time in the market, as opposed to timing the market.
Mhm.
Every time I've tried to get cute or clever by timing the market, I've gotten burned.
Oh, yeah.
So now I've learned a little bit more humility with that. Very, very smart people who are well-informed investors, many of whom are professional investors, get this wrong, right? They can't pick and choose stocks. They can't time the market. It's why actively managed mutual funds almost always underperform passively managed index funds, right?
Right.
So it is total hubris to think that you can time the market. You can always pick and choose the perfect asset. You can't do it. So I don't try to time the market. I just slowly and steadily keep investing month after month. And that
Exactly.
too is a core investment value of mine. Now, that being said, I don't want to dodge your question about where we are right now in this market and some of
Yeah.
the risks, the opportunities, because those do change, as in any given market.
Mhm.
Yeah. So first of all, I don't think that 2024 is a bad time to be investing in new real estate syndication deals. I think there are plenty of opportunities out there. What we noticed over the last year, throughout 2023, what we noticed is that sponsors really started taking risk more seriously and getting much more conservative in their underwriting and in their risk mitigation in general, in their approach to financing and loan terms. So the deals that we're seeing now are, I think, much better deals than what we were seeing a year ago, a year and a half ago, certainly 2 years ago. So does that mean, I mean, this has been a very difficult market. The last 18 months has been really hard for multifamily in particular and for commercial real estate in general.
Mhm.
I think the greatest risk was for people who bought 2, 3, 4 years ago.
Yeah.
Especially people who bought with variable interest financing, right? Those people
Oh, yeah.
got totally slammed. Um, does that mean that there are no risks investing in new deals right now? Of course not. I mean, there's always risks. There's always risk
Yeah.
in any asset, any investment, any market. There are risks. I think, yeah, I mean, one of the reasons that I practice dollar cost averaging is that my crystal ball is no clearer than anyone else's. And that's also why I practice diversification.
Yep.
But we have tried to double down actually on the diversification and spreading money among different types of deals rather than focusing largely on multifamily, because I think there's potentially less risk in some of those other asset types right now.
Mhm.
Um, I think it's a good time to be investing in real estate secured debt, for example. I think that's a safer investment. You may not see the same type of returns. I mean, with equity deals in our club, we typically aim for 15 to 25% annualized returns.
Mhm.
Whereas we're looking at a deal tomorrow. We're vetting a deal tomorrow in a meeting where it's a 10% secured debt instrument, basically.
Okay.
But it's flexible. People can get out anytime. And I mean, so yeah, there are risks in this market in 2024. I think pay extra close attention to financing terms, LTV, interest rate,
Mhm.
and the timeline, the term of the loan. We did a deal last fall that it was a fund. It was a portfolio of two hotels actually, and the sponsor was inheriting a fixed interest loan that it was, I don't know, 4.5 or 5% fixed interest, but for the next 9 years, which is
Wow.
great, right? So I don't know how those hotels will be valued in 2 years from now or 3 years from now, but I feel pretty confident that at some point within the next 9 years, there will be a good moment to sell those hotels, right? Like,
Yeah.
as opposed to getting, these bridge loans, for 2 years, 3 years. A lot of sponsors, they'll go out and they'll get one of these bridge loans or, a shorter term loan, and they'll buy an interest rate cap on it, and they'll say, oh,
Yep.
look how safe this is. We have fixed interest at 7% or whatever for the next 2 or 3 years. And my response to that is like, well, that's great for the next 2 or 3 years, but what if interest rates are still high in 2 or 3 years from now? They might be, right? Like, everyone's assuming that interest rates are going to go down, this year or at the latest next year. They may not. I mean, I don't know that. Even the Fed doesn't know that. Yeah, so, they signal what they anticipate, but that doesn't mean anything necessarily. So, so pay extra close attention to debt terms, pay extra close attention to how sponsors are forecasting expense increases over the next few years, especially compared to rent increases. It's one of the risks that we are seeing right now is very slow rent growth compared to faster expense growth. And that's a bad place to be if you have an asset where expenses are rising a lot faster than income. So you have to find ways of mitigating that, whatever those might be. So things to pay attention to.
Yeah. Well, I tell you what, you're so right. And when I was in my 20s, I was still in the corporate world, and it was right after the 401k thing had come out, and so I got in the 401k, and I learned about dollar cost averaging early on in the stock market and did quite well. And then when I started investing in real estate, it was just slow and methodical. I'd pick up a duplex and I'd pick up a fourplex, and I would, do that and built up a portfolio that over time went up in value. And eventually it got really big, and I decided I was going to, sell them and invest differently. But all along, I really decided to put my blinders on, not worry about what people were projecting as far as timing goes. It just ended up, at the end of the day, it always ultimately goes up, and a lot of times when you try to time it, your emotions get the best of you. You have a surprise downturn, and you're like, oh crap, sell everything. Then you sell at the bottom.
Yep.
Which is the opposite of what you want to do. So any case, I know we're running short on timer, but you gave a lot of golden nuggets today, Brian. This was amazing. And you mentioned the club. So how can people, if they want to participate with you in some of these deals, and I think you're going to get some takers on this, because it follows all the foundational rules. It's just a great way to invest your money. But how can people get a hold of you? How can they work with you? Anything you can do, we'll put it in the show notes too, so people can see it there.
Yeah, absolutely. So come to SparkRental.com. You'll see our co-investing club front and center there. We also have a free workshop that your audience can take. We set up a link specifically for your audience. It's SparkRental.com/massive. And that is a free workshop on how to earn 15 to 30% on hands-off real estate investments. We go into a deeper dive about how these real estate syndications work, what are some of the risks involved in them, and how do you mitigate some of those risks as an LP, a limited partner or passive investor.
Right. Okay. So SparkRental.com/passive is the workshop.
Massive. And then SparkRental.com/massive.
Massive. I'm sorry, massive.
For your podcast.
I like that too. I like the fact that there's commonality there. So /massive, and then also the investment club. If they just go to the SparkRental.com, they'll see information on the club too.
They'll see it front and center. Okay.
Well, listen, everybody listening here, do us a favor. Brian and I both, is leave a review for this. This has been one of the golden podcasts. You got all kinds of good information. You got actually something you can do and participate in. We are not. It's a lot of the gurus out there. I'm not knocking them. They're good at what they do, but they have programs that cost over $100,000 to participate. There's nothing like that here. You get to be part of a club that's analyzing the very deals that you can invest in. I can't think of a better way to invest your money and learn at the same time and network and meet people from all over the U.S. and the world. So leave a review. We certainly appreciate it. That's what makes the podcast world go around. Thank you for participating and listening. And Brian, thank you for contributing so much. And we will see you all on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.